All right, let's get it. All right. The first thing we're going to start with is it's called the quarter series, and it's marking up your strongest support and resistance levels. So that way, you don't have to like. This is the swing. This is the swing trade method of it. I'm going to give you the swing trade and the intraday trade method of it. But for now, we're going to work on the swing trade. That's the safest for a new trader to use. Um, so just a second. Come back. Come back. Come back. Come back. All right. Again, what I'm teaching you, this technical analysis style is for swing trading, but the concepts can also be used for scalping and short-term trading. The first rule is always follow Luciano's moving averages 7 and 21. The main one you want to focus on is the 21. If the 7 is above the 21, you're going to look for the pullbacks to buy with. And then if the first line is below the second, or the 7 below the 7 below the 21, you're going to be looking to sell on the pullbacks against the trend. Rule number 2, pay attention to either your MACD or your RSI. It's telling you the momentum of the market. So you want to just try to trade in line with the different indicators and the trend of the market itself. Rule number 3, you want to look for a reversal of trend or retracement after trending 3 pushes to either the high or low in a price rejection zone. And our price rejection zone is in between the 618 and the 886. All right, the goal in this section is to learn a top-down approach. You're going to identify key levels of support and resistance. This is where we learn to begin to build a bias or our list of confluences, okay? It's going to go over which charts to analyze when you're looking to trade. It's going to introduce you price action and begin to build market structure, all right? Okay, so what we have when we're looking at these charts, we've got 5 charts that all tell basically a story of price action or what's going on with price in a certain time frame. The higher the time frame, the stronger the setup. All right. So as you see right here, I've got going from left to right. The 2-hour has more weight than the 1 hour. The 4-hour has more weight than the 2 and the 1 hour. The daily has more weight than the 4-hour, 2-hour, and the 1 hour, and so forth. Certain charts are used for certain markups, though. So we only look at certain charts for certain things. The goal is to analyze from the strongest chart, in this case, the 1 month, and then to the 1 hour. So basically a top to bottom approach to build a bias and list of confluence. Monthly chart I use for the quarter series placement. Weekly I use for the weekly mid-range levels, but there's a trick to that as well. The daily to 4-hour I use for Elliott Wave placement, stop loss placement sometimes. And the 2-hour, 1 hour you would be using for the precision trade execution and the Elliott Wave placement as well. All right, so when we're marking up charts, more times than not, you want to try to mark it up, during a period of rest or when it's, closing. So typically that would be either Saturday, Sundays, or in between 5 and 9 p.m. Eastern Standard Time, and so forth. because anytime after that, the market's usually already in its move or its trend for the day or that session. So markup should be done on Saturdays and Sundays or after each trade day to pick out key areas of support and resistance along with candle formations for price action. Once you have charts marked up, generally you should not have to move the zones or mark any new levels unless a new zone is reached. And again, you always want to begin chart markups on the monthly chart for your quarter theory placement. And of course, as I said earlier, I'll show you all how to do it on the intraday aspect as well. Zones created by markup are part of course, quarters theory by Elliott Wave. The quarters theory is based on a premise that daily fluctuations of currency exchange rates are not random and that currency exchange rates fluctuate in an orderly manner between large quarter points within a 1,000 pip range for most currency pairs and 2,000 pip range for like the JPY pairs and some commodities. And they're defined by two major whole numbers, and those are going to be the swing points. Okay. So the major whole number in the example will be the swing points on the monthly chart. So the major whole number is the price number over here. So this is $1.30 to $1.40. Basically 10 cents, guys, in a normal currency pair is 1,000 pips. Okay, I'll repeat. 10 cents is 1,000 pips. Begin with the most recent swing low or high on the monthly chart. Once a swing point is found, you will round to the nearest whole number, basically, okay? So just round to the nearest whole number like this. And this is going to be marked as your monthly level. So what you want to do with this, let's say you're going to uptrend, right? If you're on an uptrend, you're going to find the most recent swing low, and you're going to look at the price over here. And you're going to just round it. Once you place your horizontal line, you're going to round it to the nearest whole number. From that whole number, you're going to add 10 cents above it and subtract 10 cents. And that's going to give you these zones, these 1,000 pip ranges. Quarters theory focuses on the 1,000 pip ranges between the swing high and low numbers and currency exchange rates and divides these ranges into 4 equal parts called large quarter points. Now this information you don't necessarily have to know too much about, but what we're mainly concerned about is the swing low, the first large quarter point, the halfway point, the major half point, and then the other point. So from this low to this high is 1,000, and then we cut that 1,000 in half right here, and that makes it to 500. As you see, it went from $1.30, $1.35, and this was $1.40. And that's this major half point is our weekly mid-range. Quarter points serve as a constant support resistance levels, as well as familiar and variable price targets. A bullish price breakout above a quarter point is expected to target the next quarter point above. And on the flip side, a bearish breakout below a quarter point is likely to challenge the quarter point below. So let's back that up. These are your quarter points right here, right? So what this is saying is if price breaks above this price right here, the next support or the next ceiling is going to be this halfway mark. All right. Let's say price breaks up above this, its next ceiling or support is going to be this mark. But more times than not, it usually these large quarter points right here, more times than not, they're broke through. So we don't really worry about those. When a targeted quarter point is reached, the quarter is considered to be completed. If price fails to complete a quarter point, the unsuccessful completion of a quarter point usually causes a reversal and takes price back toward the preceding quarter point. So this is from, ooh, this is this is a, oh, all right. So where's my mouse at? So these lines are delineating the quarter points and things like that. So from this red line to this red line is 1,000 pips. From this red line to this yellow line is 500 pips. So from this line to this line is what we've been seeing in the previous examples, right? So what happens is, as I said, these lines right here, these orange ones are typically broken through. So once we find support at the monthly level, it's going to bounce up and challenge this next monthly level. Okay. Now, even though it did come down and find support at a quarter point, which is great, it found resistance at a quarter point, which is great. You can use a quarter point. Now, I'm not saying they're not helpful, but for training purposes, we're not really going to worry about them too much just yet. But this is what the quarter theory looks like. Okay. So how do you mark it up, or what's the quarter theory's placement? Again, you find the most recent swing turn point in the market starting on the monthly chart. You want to look left to trade right. And when you're looking left to trade right, you're looking left for the candle price action patterns where market either reversed or had a breakout. Using the horizontal tool, you're going to mark your first monthly key level rounded to the nearest whole number from the most recent swing high or low in red, or whatever color you choose. The next monthly key level should be placed 1,000 pips or 10 cents above and below the first level for most pairs. Your commodities and JPY pairs use a 2,000 pip range. All right. You can use that rectangle tool to highlight the key levels to create a more dynamic zone if you want to, but we don't worry about that at all. We'll skip that one. All right. All right. So once you move from the monthly chart, you're going to go to the daily and the 4-hour charts. All right. The daily chart is used to mark more recent zones of support and resistance by looking left to trade right. Can also be a trade execution chart if you're a super swing, long-term swing trader. And the 4-hour can be used to, for your stop loss points and candle patterns for entering on the 1-hour. Here we can use the rectangle tool to create highlighted zones where price reversed or had a breakout. And that's going to be called institutional order flow. And we get into that next week once we tie it all together. It's important to zoom out a little bit on the 1-hour, on the 4-hour and the daily charts so you can get a little bit of a clearer view of the cycle. And then we alternate between the daily and 4-hour charts to line up the rectangles for maximum precision. And then that's got to do with the institutional order flow again. Let's see. And if you're having problems identifying like your support and resistance areas, just use the line tool or use a line graph instead of the price bars, and that should help you a little bit. And I'll show you this on the charts as well. So after you got done marking your key levels up on the monthly, right, you step down to the daily to highlight some more recent daily key levels or swing points in the market. Drop down to the 4-hour to see if you can mark up any kind of like Elliott Wave or any kind of trend lines or counter trend lines, as we'll go over here in the next session and things like that. And then you're just going to be looking for your zone to enter, your PRZ, your price rejection zone. Okay. We now have identified key areas of support resistance using the quarters theory and marking recent price points. We begin to read the price action of the candles and take note of where price is in relation to different key levels and dynamic zones to begin a list of confluences. A reversal pattern at a key level or dynamic zone is considered two confluences. Okay, the reason why it's two is A, you've got a reversal pattern. Two, you've got a key level or dynamic zone. All right, so that's two items on the list of confluences. You want to try to note the last candle reversal pattern or swing point off of a key level or dynamic zone by highlighting with a rectangle if necessary. All right, and I'll go over this on the chart. Your initial bias for your overall long-term trend should be started as we have provided the foundation for Elliott Wave structure to be applied next. So this section was basically a top-down approach. How do you analyze the charts? Okay, so you want to go from big to small, basically, okay? Swing traders go from monthly. Well, let me start this over. Before you ever take a trade, you want to mark up the key levels on the monthly and the daily charts because, again, even as an intraday trader, if price approaches that zone, you want to be aware of that. All right, let's just clarify that. But intraday traders typically use the daily, the 4 hour. Swing traders typically use the daily, the 4 hour, and the 1 hour charts. Intraday traders typically use the 4 hour, the 1 hour, and the 15-minute charts. All right. A general trend direction should be able to be gathered from this beginning stage. And then you've got dynamic zones and key levels are your first or your first items on your list of confluences. All right. Let's see. We're going to keep going real quick. All right. So this section is over trend lines and how to properly really apply them and how are they helpful with your trading, okay? Your goal for this section is, of course, how to apply the trend lines properly, which time frame to draw trend lines on for the most effective use of them. We're going to introduce the counter trend line and then show you how to apply the long-term inner and outer trend line application. Alrighty. So trend lines are drawn on for the swing trade method. They're drawn on the daily, 4 hour, and the weekly. For the intraday, they're drawn on the 4 hour, 1 hour, and 15-minute. For this training purposes, we're going to use the swing trade method. We begin on the weekly time frame, and we can just connect swing high to swing high or swing low to swing low, depending on the trend you're in. With the trend line, you want to have no more than 3 lines on a chart at a time, okay? And that's your inner, outer, and then your long term. Trend lines, actually, you want to extend your trend lines into the future because what happens is that trend line is respected. It's part of the Fibonacci spiral, which I'll try to show you that here in a little bit. You want to buy at bullish support above the trend line, and then you want to sell at bearish resistance below the trend line. Trend lines act as slanted support and resistance. Okay, there's usually going to be a candle formation at the trend line, and then there's either a counter trend line break or there's a trend line bounce. We look for a moving average crossover on the 4 hour or the 1 hour. So we're looking for the 7 to cross over the 21 with a trend line bounce or trend line break. Something like this. All right. So here's your swing low, right? On this uptrend, here's your swing low, swing low. So you've got Elliott Wave, A, B, C for the next wave up, right? So swing low, and then those are the areas we're looking to buy in. So in this example, once we see this uptrend come down, retest that same line, and it bounces up, On the retracement, we're looking for that retracement to end with our trend line met with our Fibonacci, because we'll fib from low to high, let the market retrace into our fib lines, met with the trend line, candle resistance, and whatever kind of key level. All right, and then you'll catch this whole move, right? But notice here's a counter trend line placement. If you miss this move right here, right? If you miss getting in over here, that's fine. You can draw your trend line, and when it breaks that trend line on the pullback and the test above that, again, we'll fib from this low to this high, met with market structure, the counter trend line, and look at your moving averages though. See how they crossed right here? So you know the rules of the strategy in the first place. When the 7 crosses over the 21, we're going to buy on the pullbacks, right? That's what we're looking for. We're going to, this pullback that we're going to buy with. So that's like 5 or 6 confluences. Let's count them off. We've got, let's see, let's on this setup right here alone. We've got the moving averages have crossed. That's 1. You got the counter trend line break. 2. Got the trend line bounce. 3. Pullback that we're looking to buy against. We fib from low to high. We're going to meet something right here. That's 4, right? Then your new highs is formed after the 3rd trend line bounce. So here's your confluences for the trend line bounce. Your trend line acting as a slanted support. You got a candlestick formation at the trend line support. You've got the counter trend line break. You've got the moving average crossover. And we've used Fibonacci. All right. So this is different lists or different items that you can build a list of confluence with that says, hey, that's a safe trade to enter. The more items you've got on that list that says enter, the better. What I would like to recommend actually as new traders is when you're looking to enter the market, begin to write down your list of confluences for each trade. And this is all a part of your journaling. Because what happens is you'll begin to identify your psychology behind the market. You'll be able to identify how you personally begin to trade. If you can keep a nice record of the trades you take, you'll learn a lot about yourself. All right. So what happens when there's a trend line break? All right. There's one of 3 things actually happens when there's a trend line break. The market retests. The first thing is the market retests the lows, and the uptrend stays in place. The uptrend stays in place. A new trading channel is created, and new buy sell zones are created. All right. So here you've got that support. I mean that trend line, right? You drew from low to high, but we extended it. This is what I mean by extended. So just draw from low to high, but just keep going. Drag it out a little bit. Because what happens is once it's broken, you're either going to see this happen. Here's the second thing second of 3 events may occur upon spotting a trend line break. The inner uptrend line breaks and the market moves to the outer trend line. As it moves to the outer trend line, it is in the sell zone of the inner uptrend line and in the buy zone of the outer trend line zone. So, for instance, here's your long-term trend line right here, right? Notice this trend line right here, because even within this trend, here's another trend. So you've got a counter trend line break that we look to sell against, right? And then we'd sell that all the way until it's met with the trend line and then reevaluate the market. And a lot of times what happens is on these zones or on these setups like this is when people see 2 different types of signals. A lot of people say, hey, go short. which they'll be correct. A lot of people will say, hey, no, we're going to go long, which they'll be correct as well. It just depends on when they're getting in. All right, the third thing that may happen on a trendline break is the market dips to a support or point A of the latest AB. Okay, remember this is the A, B, C, right? If the outer trend line is far away or there is no outer uptrend trend line, then a major reversal can occur. All right. After the market enters a sell zone, it rallies one last time to retest the backside of the uptrend resistance level before failing. So on this uptrend right here, here's your break, the retest of that trend line, and then sell. So on this move right here, we would fib from low to high, let the market retrace, and then this trend line is going to be met with somewhere in between our sell zone, in between the 618 and the 786. That's going to let us know to get in for the short. All right. Your price rejection sell zone rules. This is for the short. Okay, this is for when you're looking to sell. You're going to draw your inner outer long-term trend lines if you're able to. You're going to find the uptrend line break and the bearish candle formation in a price rejection sell zone. And that's in between the 618 and the 786. Find the backside of the uptrend line to see if it's lower than the last high. Establish the last high to determine your stop loss placement. Remember, stop loss placements always go above the most recent last high. You're going to find counter trend line, find outer trend line, as well as support to determine where to take profit. Figure out where in the cycle of Elliott Wave to gauge where the next impulse wave should end using the ABC, the extension, or the one-to-one projection. And I'm going to show you this stuff on the charts, guys. Your stop loss goes 15 to 30 pips above your entry. And then, of course, your buy zones are the exact opposite. All right, now we're going to get into the counter trend lines. Counter trend lines, they're pretty important for trade setups. They're placed on the 4 hour to 2 hours once the quarter series levels and the main trend lines are established. You want to draw from the low to high on bearish trends and from the high to low on bullish trends. Counter trend lines add the counter trend line break confluence that's met with your inmate crossover. And then we'll look for a candlestick formation fully formed and closed above that counter trend line for bullish and then below the counter trend line for bearish trends. And then we'll execute in that trend direction. All right. Moving averages, don't really need to cover. Hold on, guys. Let's see what I had. 161. All right, yeah, we'll do this one real quick too. All right, so now let's get into like the technical charting patterns that we'll add in with the counter trend line breaks, your entry setups for Tuesday, well, no, not Tuesday, Wednesday, and then tie it all together for Thursday. All right, so there are various technical charting patterns that reoccur. You got to really understand that depending on the time frame you're looking at, that these patterns take time to show. And so some of them require many candles. So the higher the time frame, the more patient, the more patience is required. Look how I spelled that. And the setups I'm talking about is like your head and shoulders, your double tops or your M's, and your double bottoms, which is your W's. I've got that backwards. And of course, there are variations of each. I touched up on this section, I believe in week 1, but I'm going to go over it in depth now that we've got a further understanding of it. All right. So here's your head and shoulders, okay? The market came up, rallied, retraced, made a higher high, retraced, found support at the same support from this retracement, rallied up, found resistance at the same resistance as this previous history point, and then fell. But when it fell this time, it broke this neckline, and on the pullback, here's another opportunity for you to get in your short, right? But once completed, currency should continue to be bearish once the neckline is broke. Upon this pullback, once this neckline is broke, here's our entry. This can appear at the end of an uptrend, or it can be at a consolidation of an uptrend. You've got 3 taps to the high. All should be followed by a bearish shift of momentum. There's also an inverse head and shoulders. So here's what I want to touch on, guys. On this head and shoulders pattern, you've got a left shoulder, your head, and a right shoulder. If we can picture these as being candles, that's a swing point. Okay. So what I mean is if we had 3 candles right here, 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 those 3 candles would look something like this. Not perfect, but you'd have on this shoulder right here, you'd have a initial high, you'd have a higher high, and then you would have a lower high, which lets you know that price doesn't want to go up here anymore. Okay, on your double tops, you got a few common chart patterns. They appear at the end of an uptrend, or they appear at the end of the pullbacks against the downtrends. Okay, you want to look for the break in the neckline for continuation, and then of course these resembles your M's and things like that. They identify resistance. We like to see these form around the key levels. And of course, these on the second peak, it doesn't have to close at the same price. It doesn't have to be like a perfect M. So you got your first rally up, failed, pullback, second rally up that fails, but here's your pullback. That typically should come down to the last swing low. It's just going to break your neckline and come down to your last swing low. The double bottom is the exact opposite. So notice though, on this swing point, right? Here's a high, higher high, lower high. That's what I mean. Low, lower low, higher low on a swing low. I got to get you guys to, we'll go in depth on these swing points again, like I said, this week too. Let's see. So here's a traditional double top. Here's the overbalance where you have a strong push down and then 2 pushes up, 2 strong pushes up that's met with rejection. And then again, on your downtrend, your pullback, your double top, downtrend, pullback, another double top. Okay, double bottoms, the exact opposite. All right. Are there any questions so far? All right, cool. I'm going to set up a chart, Elroy, for you on the quarters theory. let's see. Yeah. So I'm going to draw this up for you guys real quick. All right, where do I want to start? Hold on real quick. Boom. All right. So what we went over is tonight we went over quarters theory. We went over your moving averages, trend line, counter trend line application, and then just a few technical chart patterns. Okay, I'm gonna show you all this on the charts, but I just wanted to draw it up for you. So, okay, so when we're first coming to these charts, first thing we're gonna do, actually I'm gonna type it up for you. Blank document. All right, step one. Step one. First thing we're going to do is mark up our 1,000 pip ranges, okay? Right, pretend we're on a chart right now, right? We want to create 3 zones of 1,000 pips, basically. All right. Uh-oh. Right. So now I've got my 3 zones. 1, 2, 3. After we mark up these 3 zones, we want to be sure that the number over here are nice whole numbers. So again, we'll use $1.30, $1.40, $1.50, $1.60. All right. Once we do that, we cut them in half. Okay. So we'll have line right here. Line right here. And line right there. So now what you have is 2 500 pip ranges, 2 500 pip ranges, 2 500 pip ranges. So this would be $1.55. Let me write it down for you. Okay, so that's what we have. After I do that, guys, I typically just leave it at that. Now, what I showed you in the PowerPoint requires you to cut this range in half, this range in half, this range in half, this range in half. So essentially what you have is in between each 1,000 pips is 4 250 pip ranges.
Should that be $1.35 and $1.45?
Oh shoot, I'm sorry. I put $1.55 for everything, didn't I?
Yeah.
Thank you for that. All right. All right, so this is typically what I have. All right. So and I'm going to show you all like a perfect example of what we're actually looking for or what we're doing. Okay. So what we do is I'm going to show you guys the complete wave cycle. All right. So what I've marked up is, let's see, a few different cycles of Elliott Wave. Okay. And what I'm going to show you all, pretend like these prices are just, they're even whole numbers, but they're not as wide as they are. Like we'll just go from like, pretend like this is within 1,000 pip range. Now, this is what we're going to see happen once price approaches those key levels that we marked earlier. You'll either see a breakthrough or rejection. All right. And with these levels, these are the areas where we're looking to enter around. Okay. And I'm going to show you this on the charts. All right, guys. So don't worry about it. So on this uptrend, we would fib, let me see. Yeah, that's fine. So we would fib from low to high and then let the market retrace. We want to see a fib level met with this key level. All right. Once we see a fib level met with the key level, we're looking at these swing points to see the reversal patterns. All right. Not only that, we should be able to draw some kind of trend line that goes up as well, because if that happens, we're going to, buy, assess it again over here. And if it breaks through, guess what? On this pullback, this next pullback, you can enter again, a second buy. That's in line again with this buy. Your second entry. Wait for the next major pullback, right? Then we'll fib from this low. Oh, let me pick a different color. We fib from this low to this high to find this retracement right here. And this retracement should be met with some kind of previous support. Look left to trade right, met with the fib, met with your key level. So we're going to look at this swing point for our next opportunity to buy, right? Because this high and this high is going to get tested. It hasn't been tested yet. And sure enough, let the momentum change on the pullback. fib from this low to this high to find this swing point, met with the Fibonacci, met with the key level, and you catch your buy. And that's the whole strategy, guys. Okay. And that's really all it is to it. But I have to get you guys to identify the market structure at these swing points. I've got to get you guys to understand some of the timing behind these setups, as far as the swing trade setups and things like that. And then I just got to get you guys to build some confidence with it, really. And that's it. Now let's hop on the charts real quick. Do y'all have any questions so far about what I've shown you?
Can the fractals be used to identify swing points as well?
Yes, that's why we use the fractals.
All right.
Okay, so you'll see a fractal here, fractal here, fractal here, fractal here. On this second fractal, if you're already looking to buy, and this second fractal is either at the same low or higher than that first lower fractal, that's your entry point. Okay. Again, for this, like, you'll see a fractal right here, and you'll see a fractal over here. That's your entry point. On that second fractal that's higher than the previous one on an uptrend, that's your entry point. On the downtrend, you'll have a fractal right here and maybe a fractal over here. But you're definitely going to have a fractal right here. So if you see this move down, wait for the market to retrace, make a second fractal that's lower than this fractal, and then enter your sell. All right.
Yep.
Let's see. Let's go to the charts real quick. All right. I'll get out the park. Mark you out the park. All right. So you see on this chart, I've already got it marked up as with my key levels, my weekly and my monthly levels, right? Let me zoom out. Let me go back. Ooh, what are you? All right. So what I did when I was marking this up, I went from this low basically to this high. Okay. So starting from this low, notice where that it's at a nice whole number, right? 96 even.
And that's the low of the week, or
No,
just the?
this is on. I'll start with the first chart. Hold on. You are cat. No. Let me see. Yeah, I'll do USDJPY. It's not marked up at all. Good deal. All right. All right. Training purposes, I'll use this. All right, so this is the USDJPY in the monthly chart. Okay, this is a fresh chart. It's like I've never analyzed it or anything like that. So if I'm going to look for a trade on this chart, first thing I'm going to do is mark up my key levels. All right, so we'll look at a zoomed out approach. And I'm just going to notate the most recent trends. So I see the bullish trend right here, the strongest bullish trend. And I'm going to mark it up from this swing low to this swing high with the horizontal line, okay? So from this low, I'm just going to, put my line on the chart around this low, right? But I'm looking at the price over here. So this says $75.98, right? So I'm just going to put this at 70. I can either put that at 76 even or 75 even. I'm going to put that at 76 even. All right. Now remember, this is a JPY pair. JPY pairs, they're quoted a little bit differently, and we want to do a 2,000 pip range. So instead of doing 10 cents, right? On this, the way this is quoted, we're going to go from 76 to 96. I mean 76 to 86. We're just going to do $10. Uh-oh. All right, so here's my original line. Here's my next line, right? Notice what I'll do though, is you see these fractals, how price is respecting this price zone of $86 even.
Yeah.
And that's what we want to see when we're putting these lines on there. So I can go copy and paste again. Uh-oh. Delete. Now I'm just going to go above to 96. Make sure price is respecting it as well. And then I can do $1.06. And then I'm going to do a few more zones. So since this is the most recent price, these zones down here don't even matter anymore.
Okay.
So you don't necessarily have to mark them up, but you're able to if you can. So I would do one more above this $1.06 or $1.16. All right, and there we have one zone, two zone, three zone. The second step to that is we got to cut these zones in half.
Right. I remember you were saying for the JPY pairs, they should be 2,000 pip zones.
Yeah. I'm gonna go deeper on that because I forgot they're quoted differently than like the Euro USD and so forth like that. So what I did instead of using 10 cents, I did $10, as you notice.
Yeah.
It's basically the same concept.
Okay.
It's just to a bigger magnitude because they move a lot more. So I'm going to cut this zone in half, this zone in half, and this zone in half, basically 500. So from $1.06 to $1.16, to cut that in half, I'm just going to go 5 above that, so it'll be $1.11 or 111 even. I'm going to change the color of this line though, so I can identify what kind of support or resistance or what kind of key level it is. All right, and as you can see, it's already, we hit this line a few times, broke through it, now it's above it. It's either going to break down below, as it should, or it's going to find its support and pop up. So let me finish cutting these other two zones in half. And then once we have these lines on here, we're going to just basically validate them. And what I mean by validate them is we're going to look left to trade right. We're going to look left at previous price swing points to see how it reacted at those price points. And that's why we use these levels as our entries. Does that make sense? Do y'all see why now? Because it's more times than not, it's a good chance it's going to go your way if you've got the right analysis on it. Because it's either going to bounce or break through. If you know the trend, here's your pullback, it bounced right off of it. Trend, pullback, bounced right off of it. Trend, pullback, it bounced off of a monthly right here. Y'all see how that works?
Yep.
Trend, pullback, bounce off a monthly. Now it's testing it's closing below the monthly, so you know it's going to go short until you see some kind of bearish movement up, which isn't a lot. So here's your high. You've got a lower high. You're looking to go down. So once you're done with marking up your 3 zones, you can go to the daily chart. And then just zoom out a little bit. And on this chart, guys, you can mark up like your most recent swing points, just like we did on the monthly chart. But you'll use a different color line. And you're not going to mark up every swing point, just, you know, like the major ones, from like this swing high to this swing low. Just the most recent ones, you know what I mean? So we'll go right here, turn that into a daily. We'll go right here, turn that into a daily. Let's see, and then we'll turn, zoom in. We'll do that one right there. I like that. All right. So as you can see, I kind of did the same thing as I did on the monthly chart, just on the daily with a different color to mark up more recent swing points. Okay. Let's show you something real quick. Tonight I've got UJ going down. If it pops up some more, well, ultimately I've got UJ coming down, but I've got it popping up to test maybe the bottom of this support or resistance, especially this daily right here. And I'll show you why. Remember the technical charting patterns of the head and shoulders. Right? High, higher high, lower highs. The neckline's broke already.
Yep.
So now on this pullback, or this retracement, we're looking for it to test and fail above that. I mean below this. Before it to continue down, test this low. So since we're looking for to basically pop up, or to continue down, we're going to let it finish or let it retrace into our levels, right? Let's go to, from the daily chart, we'll go to the 4-hour chart. Let me get this off of there. Because now we can apply a few things. So since we're waiting for basically the market to retrace into our levels, right? This is when we can place our trend lines. And then this is your trend line break. Met with your moving average crossover, right?
Right.
So if you see the trend line break and your moving average crossing over, what I would do, build from that low to the high, and look what happens on this trend line break. You wait for the pullback to come in, as I showed in the example, and guess what? In between the 618 and the 786 is our entry, right? you catch this move coming up. Now, where it comes up to, remember the long-term view is short, right? You feel the downtrend. And here's our extensions. The 272 and this 1618 right here. Ultimately, we want to see price fail. Well, in between this zone right here. But knowing how the market is, or looking at where the market is that it's failing at 382. Not only that, it's failing below this weekly level. So this 382 was our entry for the short. Okay. Remember the other training about the 382 bounce?
Right. That should drop fast.
Right. It should drop fast. But remember, this is a longer view, or a long-term view. So that fastness is going to be a drawn-out process to us.
True.
Okay. So what happens is, since we see this first rejection at the 382, and we're ultimately going to go short, if that 382 level holds, as it looks to, because you got the fractal right here, this swing point, you got the fractal at this swing point. So you got the high, the opening of this candle sets the lower high, and then the closing of this bullish candle sets an even lower high than those three. That's your swing point that created that fractal. Oh, and it's also closing below this weekly level. So it's a lower swing point than this one that says, hey, that's some bearish movement. If it does pop up, let me get this off real quick. Zoom in. So notice, this fractal pinned at my ideal entry of the 786, bearish movement, retracement, that didn't break that structure of the weekly, so this next move should be down. And it's going to, I think I might enter with this 9 o'clock candle right here, actually. I think I'm going to enter a short. Hold on real quick. Excuse me. Well. Not really in between my time. I'm not gonna enter just yet. I'm gonna show you how I'm gonna gather my entry, right? On this short. So we're looking at short. Now I'm gonna be stalking my short. From the 4 hour, we'll go to the 1 hour to see if we can get a better view of what's going on, right? I don't want to rush this process with you guys yet. So here looks like a totally complete different view of what's going on. So you see this fractal to the low, but there's a fractal on the 4 hour to the high up here. This fractal to the low is what we want to see. Okay, because what we want to see now is for a fractal to form to this high that's lower than this fractal on the 1 hour, which is going to super confirm your entry for the short. So my thinking is upon the closing of this 9 o'clock candle, depending on how much bearishness it gets, we'll enter the short. But let me show you guys something. From the 1 hour, we can go all the way down to the 15-minute chart. Y'all see this fractal right here?
Yeah.
Another fractal should form over here. So about let's say 9:15, 9:30-ish, you could potentially enter the short for that move. But sometimes I can go all the way to the 5-minute chart, and guess what? That fractal's already there. And then that's how I usually get my wick entries and my perfect entries and things like that. Let's see. Y'all got any questions just yet?
No, going good so far. Would you call that W formation there at the bottom?
Right here?
Yeah, for that 2-hour chart, yeah.
Yeah, you could say this would be a W formation. Because what happens on the W formation, if you see a strong move like this, then what's going to happen is this low has to be retested.
Yeah.
So upon this retracement, we fib if you think the trends are going to reverse. And more times than not, in between the 618, as you see where these candles are usually closing at, this pin bar took you out your stop loss, but you could have re-entered safely and got back in for the long. Now, like I said, this whole move right here found resistance at the 382, which I like to see my retracements come in deeper. I like my retracements to come into this deep zone right here. But again, the 382 with this lower, high, lower, high, lower, high, lower, high. That's all just telling you, hey, still go short. So what happens is it's forming a wedge, and this is another technical pattern, which we get into later on. This is called well, actually it's a pennant, a bullish pennant. Bearish pennant. Got your bearish pole. Here's your pennant formation, so it should pop back down. Let's go to the day. Now, where it should pop back down to is the extension levels. Now, this should be a 1-to-1 move. Well, actually, yeah. So from this right there to that right there. So what I did was from this bearish move and here's your pullback. I went from high to low with a trend line, and I just drug it. I put that high. That was at this high, at the high of this retracement. Now the low should give you a projection as far as where this downtrend should end. All right. So looking at this right here, it's met with our second extension, our TP2, which is met with a daily key level, right? And then not only that, if we fib from this low to that high, guess what else is right there? Our entry zone for the buy. And that's really the cycle of the market. And you can catch this setup all day, every day, guys. You know what I mean? Regardless, doesn't matter what time chart you're on, what time frame you're on. Let me show you guys the intraday version of it. So for the intraday, I would start on my daily chart for sure, and I would mark up just a few more daily key levels as far as, and what I mean by that is I'm looking for the breakthrough of a price and a pullback, or a trend and a pullback. So for instance, this pullback, this is I would say this would be a nice level to actually mark up, because previously it bounced, bounce, breakthrough, bounce, bounce, breakthrough, rejection, rejection, breakthrough. All this structure right here. So you want to notate that. Next, I would probably do, and again, if you're unable to see it at first, switch to a line chart, because it shows you some different stuff. And then just go back to your candles. Now, whenever you see like a weekly and a monthly or met with a daily, remember, the higher the time frame, the stronger that level is. So if it's at this weekly level is way stronger than this daily level. All right? So just keep that in mind. The higher the time frame, the stronger the setup. It's going to override anything that's below it, basically. Let's see. So then once you mark up your, your daily levels, you'll go to your 4-hour. I don't know if I can. Let's get rid of these. Now, we could do a counter trend line on this one too. So from this, well, that didn't work too well. All right. So upon this, here's what we want to see. Man, that into that short. Move the pull back. Hold on, guys, real quick. All right, there we go. So, sorry about that. So, this right here, this first bottom line that I'm going to make pink, that is called your counter trend line. Okay. Here's your main trend. Your main trend is going down. Our trend line looks to be trending up. That's why I call it a counter trend line. Right? This top trend line right here, I drew that because that's also a trend within the self. And as you notice, every time price met with that trend line, it bounced off of it. So now we're on a bounce off, right? Met with your weekly short, your weekly mid-range, which price closed below on this bullish run, met a ceiling, so now it's going to continue down. Your fractal's already to the high, so we're going to continue down until the next fractal below formed below, right? Met with support. Let's see. So let's go to the 1 hour. Let's see. So where do I think this is going to get a good TP? My first TP for this short, guys, on this swing trade or even intraday, $1.10.30, or I can even put a $1.10.350 just to be safe. But first take profit is always the extension. Notice this is the next low that hasn't been tested yet. All right. So here's the setup on this though, guys. All right. Let's see. On this short position, we entered in, I believe, up here. Stop loss goes right up there. First TP right there. It's a little bit over a 2-to-1 risk to reward ratio. I mean, reward to risk ratio, right? It's at 70 pips. 30 pip stop loss. All right. Let's see. So that's one setup. Oh, see this fractal form right here on the 1 hour? This is where I say I like to see the retracements come in a little bit deeper. But even if it does get up above it, I doubt it to get up above it just because it's closing below this weekly. This week I'm actually going to go over areas like this, areas like this, areas like this. I'm going to give you all like the market structure and the candle patterns we look for in these areas. For instance, we look for engulfing candle patterns, which is the first one I'm going to teach you all. That way you can get your entries down and understand the market structure behind it all. Let's see. Y'all got any questions?
I'm cool.
Cool.
I and actually that currency, that pair you pick, USD JPY, is actually a good call, because when it reaches the end of that wedge, you call it, I call it the regular triangle.
Yeah.
When it reaches at the tip, then it's gonna break out and shoot down, and a lot of pips can be caught right there.
Exactly. And keep in mind, that original setup really came from the daily chart, knowing that it's still got all this down here to get to.
Yeah.
So, yeah, man, it's some heavy movements that can be caught with this method.
That's one of the method I use too.
Yeah.
Yeah.
That's what's up.
And the way you use your Fibonacci, I'm happy to see you use it that way, because I use it the same way. So now I know I'm not doing it wrong.
Yes, exactly. No, so that's nice to confirm that with you though. So that's good stuff right there, man. Yeah, that's really all I had for you all tonight, was to get you all to understand the whole thing and break down the key levels, why we use the key levels. Show you all the different um, trend lines, counter trend lines, the moving average breaks and their crossover and things like that. Other than that, well, honestly, yeah, I think it wanted to pop up already a few times, but it failed. So yeah, it still should break down. Let me go over this little area with you. Hold on. Delete. I want to show you guys something about market structure. All right. So this little area right here is what I'm talking about. Well, actually, let me highlight it for you. All right. So when we're referring to market structure, I'm referring to swing points and the candles that formed at the swing points. The opening and closing of a candle is a telltale sign to price action or price from what's going to happen in the market. And what I mean by that is like the wicks and these candles with no wicks on them and where they're forming with no wicks on them and things like that. So if we know that this is a low point, right, and then we see the rejection come down, these next bearish moves, if they don't cross this low point, you're in a buy situation, okay? And before we ever enter a buy situation on something like this, we want to see strong bearish movements towards this low that don't break. So what I'm going to do is I'm going to use this tool right here, and I'm going to highlight some structure points, okay? Let me zoom in. This is like a preview of what's coming Thursday. All right. So looking at these candles, right, I want you all to see where they're closing and how they're pinning in relation to these green lines, right? These two candles, strong bearish moving and engulfing, didn't cross this low. Strong bearish moving, didn't cross this low. Pull back, another pullback, bullish move, pullback, right? So if we know we're looking to buy and we see this move right here and we fib from low to high, this is the 786 entry that these candles are sitting up and closing up above in between our 618 and that 86 entry zone. But you're still looking to enter in enter in long, right? Not only that, these lows, here's your lowest low, here's a higher low, all higher lows than this low. 1, 2, 3. That is a swing point within itself. Okay? Remember I said a swing point usually looks like something like this. It's got at least 3 candles. Here's a high, a higher high, and a lower high. You've got your low, lower low, but a higher low. And each of those lows are still higher than this first initial low. So that's your buy situation. All right. So even if you see these pin bars to the top that says, hey, price may not look like it wants to go above that, and then you see this engulfing, this right here is a 2 candle formation that says sell. But even on this sell, it still never crossed this low. So you're still in that buy situation. Now, let me get deeper than that. I'm going to show you something. You remember the big wedge, right? That we're currently trading within. Let me show you the small wedge. And then this is how it's traded. So if you wanted to, you could go off either the bodies of candles. Right? Here's your counter trend line, or the top of the wedge, or the flag, whatever you want to call it. Here's your trend line break, the retest to it. That still never crossed that low, right? And shot out of there. Just delete that. But yeah, that's something that's coming up on Thursday. We're going to get into the anatomy behind these swing points. That way you all can comfortably enter based off of price action and things like that. You know what I mean? Let's see. No questions for tonight, though.
No, that's a lot to go through.
Yeah, it sounds like a lot, but I promise, once you all just see the repetitiveness of it, and things like that, like it's like that's what all we'll do Thursdays, just like look at these different swing points and show you the anatomy behind the candles and what they.
Oh, I do have a question. When you're talking about how many lines we should try and have on our charts, you said no more than maybe 3 or 4 on the daily?
Trend lines, yes,
Trend lines, okay.
yeah. So what I mean by that is, let me see if I can find an example for that. I'm sorry. Okay, let's go to Euro. Euro usually has a good one. All right. So from this low to this low, we drew a trend line and drag it out to the future. This is going to be your long-term trend, right?
Right.
Now from that second point, we can draw another trend line that goes to this low point of the retracement, which would be our inner trend, okay, or our immediate trend. From that same point, you draw to that other low, and this is your 3. So inner, outer, long term.
Ah, okay.
See how that works?
Yeah.
So this is your immediate trend, right? So this is one leg. Within that one leg, you also have retracements, though. Those come into effect with that first trend line. After that first leg, or after that first impulse wave is completed, you've got the larger ABC correction, which comes in play with the outer trend line. Once this whole complete leg is done, which is going to be completed on the daily chart, it'll retrace to this long-term trend before popping back up again. And that's how they work.
Makes sense.
But yeah, that's the 3 trend lines. So that help you out?
It does. It does.
Good deal, my man. That's what's up. All right, guys. Well, I kept you all for an hour and a half tonight. I think that was long enough. Because it's a lot of information we got to go through. So I just got to get it to you all bit by bit. I'm going to upload this video tonight for you all to rewatch it and then try to apply some of the techniques. I know it all may sound like a lot right now, guys, but remember, I'm breaking it down to you to like on different levels, so that way you go out and understand it as a whole. So don't be like intimidated by the length of it or anything like that. But it's just all good information that you really want to know and need to know to be a successful trader. Because it's a lot of nuggets and a lot of information that I'm actually giving to you as far as like market structure that I'm not really aware if it's really out there in the training videos on IML just yet or anything like that. I can't remember, but as long as I'm helping you, I'm good.
When is the next class?
Next class is Tuesday. I mean, not Tuesday. Next class is Wednesday.
Okay, same time, right?
Yeah. So we got today's Monday. We had a class with me. Tomorrow night we've got class with Stevenson Linder on IML TV. And then
That's
I come
tomorrow
back.
night?
Yeah, that's tomorrow night. He's on there Sundays and Tuesdays.
Okay, cool.
And then I come back Wednesdays and Thursdays with more of this training.
All right.
All right.
Sounds good.
Good deal, guys.
Yeah.
I'm good.
All right, man. I appreciate y'all hanging out with me tonight. That UJ is actually a pretty good setup, so just monitor that. Like I said, it could pop up a little bit just to test that high, but your stop loss should be above that anyways. And I'll look for some more setups tonight and send them out there in the chat groups.
Cool.
Beans?
All right, big brother. You have a good night.
All right, now y'all stay easy.
Peace.
Be safe, bro.
Yes, sir. Yes, sir.